The investor associated with The Big Short who incurred catastrophic losses of $9.4 billion was Howie Hubler, a trader at Morgan Stanley. The story represents a dramatic counterpoint to the successful investors profiled in Michael Lewis's The Big Short. Here's a breakdown of his role and downfall. 1. Who was Howie Hubler? Role: head of Morgan Stanley's asset-backed securities trading group. Strategy: oversaw investments in collateralized debt obligations, particularly risky mezzanine tranches tied to subprime mortgages. Reputation: initially hailed as a bond genius. His team generated $1 billion in profits in 2006 alone, too. 2. The negative basis trade, gamble. Hubler's infamous bet involved a complex strategy: selling protection. He sold credit default swaps on risky mezzanine CDO tranches, collecting premiums from buyers betting against them, buying protection simultaneously. He bought CDS protection on supposedly safer super senior CDO tranches, expecting these to never default. Flawed assumption. He believed the super senior tranches were money good, while mezzanine losses would be limited. Correlation risk was severely underestimated too. 3. Why the strategy failed: market collapse. When subprime mortgages defaulted en masse, all CDO tranches plummeted in value. VIN AAA-rated super senior slices too. Massive payouts. Morgan Stanley had to pay billions to CDS buyers who bet against the mezzanine tranches. Worthless protection. The CDS protection Hubler bought on super senior tranches paid little because counterparties faced insolvency too. Leverage. Morgan Stanley too. $14 billion in subprime positions too. 4. The aftermath. Losses: $9.10 to $9.4 billion. One of the largest single trading losses in history too. Morgan Stanley's crisis. The loss contributed to a $10 billion overall hit from mortgage-related assets in 2007, forcing a $5 billion bailout from China Investment Corp. 2. Hubler's exit: he resigned in late 2007 with a reported $10 to $40 million in prior earnings, but became synonymous with Wall Street hubris too. 5. Connection to The Big Short: contrast to protagonists. While Michael Burry, Steve Eisman, and others shorted subprime CDOs, Hubler bet long on their stability and lost catastrophically to 5. Mentioned in the book, Lewis highlights Hubler as a symbol of institutional blindness. Merrill Lynch also suffered heavy CDO losses, but Hubler's individual loss was unmatched too. 6. Legacy: Hubler's loss exemplifies over-reliance on ratings. AAA ratings for super senior tranches proved meaningless. Correlation blindness: assuming diverse mortgages wouldn't default simultaneously was fatal. Moral hazard: traders reaped bonuses during wins, but faced limited accountability for losses. Systemic risk: his trades accelerated Morgan Stanley's near collapse, highlighting Wall Street's fragility too.